Welcome back, everyone. Today, we're unpacking a truly fascinating reality. Technology is quietly, but radically, rewriting the rules of the money you use every single day. Look, if you still think the financial world is just about dusty bank branches and traditional FICO scores, you are in for a massive surprise. In this explainer, we're going to see exactly how the financial landscape is being turned completely upside down, using the very structures that used to define it. Let's get into it.
Okay, so here's our roadmap for today. We're covering the new fintech reality, how Uber is basically becoming a bank, JPMorgan's massive startup pivot, the hidden costs of AI, and what all of this means for the next era of finance.
Section 1. The new fintech reality. The old rules? Yeah, they are completely dead.
It used to be so simple, right? In the old days, companies just stayed in their lanes. Tech companies built software, and traditional banks held all the power over our money. Highly predictable. But in today's reality, those boundaries are literally dissolving in real time. We're living in this wild new world where tech giants are suddenly becoming lenders, massive legacy banks are frantically trying to act like agile startups, and AI innovators are figuring out that swapping human salaries for algorithms comes with some seriously massive server bills. The entire circle of life in fintech is spinning totally out of traditional control.
Section 2. Uber becomes a bank. A rideshare app is launching a credit card.
Let's start with a company we all know. Remember when Uber was literally just a way to get a car? Well, Uber just launched its first credit card globally. But here's the kicker. They didn't launch it in New York, and they didn't launch it in London. They launched it in Mexico City. And the reasoning behind this is just brilliant. In Mexico, nearly half of the adult population, 49%, is entirely unbanked or underbanked. By targeting this highly specific market where Uber already has one of its deepest Latin American footprints, they suddenly have a target market of 32 million potential customers totally within reach.
Now, Uber is absolutely not doing this alone. They're using what's called an embedded finance stack, which is exactly how modern financial products are built today. It's like a giant puzzle. Uber's role is pure distribution. They bring 25 million active Mexican users to the table with a super seamless 3-minute in-app application. Then, a Mexican fintech named Klar steps in as the backbone. They handle the actual underwriting and the banking rails to offer credit lines up to 250,000 pesos, which is roughly $12,500 US. And finally, MasterCard provides the global acceptance network and tokenization, offering everything from standard 7% cashback up to platinum 10% back with VIP lounge access. Every single partner plays a highly specific, vital role.
But exploring this stack raises a really incredible question. If 49% of this market is unbanked, how on earth do you underwrite millions of new users who have absolutely zero traditional credit history?
The answer? Data. Uber just turned 25 million active ride receipts into a massive credit underwriting dataset. They aren't relying on traditional banking credit scores at all. They are using alternative data. Suddenly, your history of taking Ubers to work every morning or paying for late-night food delivery is the secret weapon allowing Klar to underwrite these loans. Uber's first financial product relies on the data they've been quietly collecting on us for years. And listen, if it works here, you can bet this template is going to go everywhere.
Section 3. JPMorgan acts like a startup. The ultimate legacy bank pivots. So let's shift gears from a rideshare app to literally the biggest payments operation on the planet. JPMorgan Chase. Consider this number for a second. $12 trillion. And that is not an annual figure. That is JPMorgan Chase's daily payment processing volume. Daily. They're the largest U.S. credit card issuer and merchant acquirer. An absolute titan.
Which leads us to a very perplexing question. With $12 trillion flowing through their systems every single day, why is the most powerful bank on earth suddenly studying its competition out loud? Recently, American Banker published this feature detailing exactly why JPMorgan's payments division feels the urgent, pressing need to think and act like a fintech startup just to stay on top. And trust me, this isn't PR spin, it's a major tell.
The reasoning is surprisingly straightforward. These legacy banks are fighting a three-front war right now. First off, nimble little fintechs are steadily chipping away at their merchant acquiring margins. Second, neobanks are capturing checking account market share from younger consumers who basically never want to step foot inside a physical branch. And third, embedded finance stacks, exactly like that Uber and Klarna partnership we just talked about, are proving that massive distribution networks completely beat traditional banking licenses when it comes to a business moat. So in response, JPMorgan Payments is throwing out the big bank playbook entirely. They're rapidly responding with developer-friendly APIs, aggressive new partnership models, and just unprecedented product philosophy.
The whole situation was summed up perfectly recently with this analogy. It's the financial equivalent of the Yankees hiring a sabermetrics department. The resources were never the problem. It just perfectly captures the moment, right? The ultimate heavyweight champion is finally weaponizing its unmatched resources with genuine startup agility. When a giant like this studies the competition out loud, startups should definitely feel validated, but they should also be a little bit nervous.
Section 4. The hidden cost of AI. A fintech darling gets a reality check.
For our final case study, let's look at the company Block, led by Jack Dorsey, to see how artificial intelligence is radically changing the internal mechanics of finance. Back in February, Block executed the largest AI-driven layoff in corporate history. They slashed their headcount from 10,000 employees all the way down to under 6,000. The core thesis for this massive cut was that their open-source agent framework, which is called Goose and boasts over 27,000 GitHub stars, by the way, could just seamlessly replace whole categories of human labor.
And honestly, at first glance, the trade looked incredibly clean. Following those cuts, their Q1 2026 adjusted earnings per share jumped by a staggering 51.8%. Replacing people with AI seemingly solved their massive headcount problem basically overnight.
But now the other side of the ledger is showing up. Matt Ross, Block's head of investor relations, recently posted a really revealing thread online, noting that token cost discourse is having a moment. He explained that while human payroll absolutely dropped, their AI compute bill is skyrocketing. To manage this, Ross pointed out that Block is now focusing on building highly efficient world models for financial intelligence, rather than just relying purely on expensive large language models. He called it full self-driving for money, not LLM-based. They are essentially treating AI in finance the exact way Tesla treats cars, autonomous, highly specific, rather than just using some generalized chatbot.
We are witnessing a fundamental shift in the modern fintech backend. Historically, if you wanted to scale, you hired more humans, which meant high-salary headcounts and much slower growth. Today, scaling means deploying AI agents like Goose, MoneyBot, and ManagerBot. But here is the really ironic twist. While you don't have to pay a bot a salary, the compute demand to keep them running is scaling so much faster than anyone anticipated. To protect themselves from this, Block engineered Goose to be totally model agnostic. Their engineers actively toggle between Anthropic, OpenAI, Gemini, and open-source models all the time. Why? Because AI token costs fluctuate wildly, and getting locked into one provider is a complete financial trap. It's wild. Even the most AI-native fintech in the world is now having to field investor questions about their server bills.
Section 5. The next era of finance. Let's synthesize this disruption.
So what's the crucial takeaway here? How does all of this connect? First, we know embedded finance has no zip code. Uber's launch in Mexico proves that distribution platforms can deploy financial tools literally anywhere in the world. Second, size absolutely does not buy you immunity. JPMorgan proves that even processing $12 trillion a day doesn't protect you from needing to act like a scrappy startup to fend off nimble competitors. And third, the AI productivity trade? Yeah, it comes with invoices attached. Block proved that while you might solve a human headcount problem with AI, you are simultaneously creating a massive compute budget problem.
Which leaves us here. I really want you to think about this for a second. If a rideshare app is your new bank, and a leading fintech's biggest problem is no longer its payroll, but its server bill, what will the financial institutions of tomorrow actually look like? The rules have changed, and the disruption is honestly just getting started. Thanks so much for learning with me today, and I'll catch you in the next explainer.